This next chapter is a bit of a refresher on the bookkeeping process and transaction analysis related to accounting. Some of the things you'll cover in the text and in this lecture, we'll look at the expansion, the basic accounting equation. We'll describe how it stays in balance. We'll describe how the income statement is linked to the balance sheet through the stockholders' equity. We'll talk about some of the bookkeeping terms. It's important that you know what those mean. We'll explain why the bookkeeping system is a mechanical adaptation of the expanded accounting equation. We'll analyze transactions, look at some journal entries, and determine the effects of the transaction on the financial statements, and apply the 5 questions of transaction analysis. Just as a refresher, the accounting equation, also known as the balance sheet equation, is a mechanical key. And it's written as assets equals liabilities plus stockholders' equity. This basic accounting equation can be expanded to include revenues and expenses. There are 2 major components of stockholders' equity. There is the paid-in capital, which represents the investment of the stockholders. That is the accounts such as common stock and paid in excess of par, common stock, preferred stock, and paid in excess of par, preferred stock, and retained earnings. And retained earnings represent the accumulated earnings of the company to the current period in time, less any dividends that have been paid out. Earnings or net income equal revenue minus expenses. Here we have what's called the horizontal model, which shows the effect of recording transactions A through F on the accounts in the balance sheet. Transaction A, stockholders invested $2,000, results in an increase of $2,000 in cash and paid-in capital accounts. Transaction B, the company borrowed $6,000 from a bank, results in an increase of $6,000 in cash and $6,000 to notes payable accounts. Transaction C, equipment costing $10,000 was purchased for $2,000 in cash and signing a note payable for $8,000, resulting in a decrease of $2,000 in the cash account, an increase of $10,000 in the equipment account, and an increase of $8,000 in the notes payable account. Transaction D, equipment that cost $3,000 was sold for $3,000. The $3,000 will be received within 30 days, results in a $3,000 increase in the accounts receivable account and a $3,000 decrease in the equipment account. Transaction E, the company provided services for $8,000 and received cash, results in an increase of $8,000 in the cash account and an increase of $8,000 in the revenue account. Transaction F, wages of $2,000 were paid in cash, results in a $2,000 increase in the wage expense account and a $2,000 decrease in the cash account. You'll notice that effectively the balance sheet equation stays in balance with all of the entries. The impact of the revenues and expenses is $6,000. The financial statements can be prepared after summarizing the entries in the accounts in the horizontal model. See, we have the total amounts. The income statement will report the net income for the accounting period. Total revenues of $8,000 less total expenses of $2,000 result in net income of $6,000. Net income of $6,000 is then added to the beginning stockholders' equity and is part of the ending balance of stockholders' equity, which is reported on the balance sheet. The balance in the asset accounts, cash, accounts receivable, and equipment, and the liability account are transferred to the balance sheet. The paid-in capital account balance of $2,000 is combined with the newly calculated balance in the retained earnings of $6,000. Total assets must equal liabilities plus stockholders' equity. Liabilities are $14,000 and stockholders' equity is $8,000, giving us a total of $22,000. This ties back to the $22,000 of assets that are on the left side of the balance sheet. We're going to start talking a little bit about some of the terminology and what we call the jargon. And this is often referred to as bookkeeping jargon. This is a review, and it's a relatively quick review because you covered all of this a little bit more in depth in your ACC 121 classes. I believe that's chapter 3. Bookkeeping is one part of the accounting process. Transactions are initially recorded in the general journal. Transactions are then posted to the individual accounts in the ledger. Accounts are used to organize or group transactions to facilitate the financial statement preparation. One of the tools we use with bookkeeping and accounting is the T account. T accounts are used in accounting courses as a tool to represent what an account is. They really aren't an actual part of the entity's accounting records. They give us something to use when you are learning or when you are analyzing specific transactions. Sometimes it helps to look at how something would work. The name of the account is written at the top of the T account. The left side of the account is the debit side. The right side of the account is always the credit side. Overall, debits and credits affect the accounting equation, as we're going to illustrate here. Asset accounts are increased on the left side with a debit and decreased on the right side with a credit. Liabilities are increased on the right side with a credit and decreased on the left side with a debit. Equity accounts are increased on the right side with a credit and decreased on the left side with a credit, with a debit. I apologize. An easier way for students to potentially remember this concept is to relate the T account increases and decreases back to the accounting equation. Assets are on the left-hand side of the accounting equation, therefore they increase with debits. Liabilities and equity accounts are on the right-hand side of the equation, and they increase with credits. Stockholders' equity is the particular little glitch for many students. Keep in mind that there are two components to stockholders' equity. There's the paid-in capital and then the retained earnings. Retained earnings is the amount of earnings to date less dividends paid. So first we're going to discuss revenue. Revenue increases, represents increases in stockholders' equity. So revenue accounts will increase on the right-hand side with a credit. Expenses, though, represent a decrease to stockholders' equity and therefore will increase on the left-hand side with a debit. Our next slide, which represents the accounting equation, also contains a little bit of a chart here for you that talks about normal balance and how something will increase or decrease, whether it's on the debit side or the credit side. The normal balance of assets and expense accounts is the debit side, because debit entries are the means through which we increase these accounts. Credit entries in asset and expense accounts decrease those accounts. Normal balance of liabilities, stockholders' equity, and revenue accounts is the credit side, because credit entries increase those accounts. Debit entries and liabilities, stockholders' equity, and revenue accounts decrease those accounts. The normal balance of an account is reflected on the same side of the T account in relationship to the accounting equation. The normal balance of an asset account appears on the debit side of the T account because assets are on the left-hand side of the accounting equation. A general journal is the book of original entry for recording transactions for an organization. Typically, the journal has a column for the date, a description, a debit, and a credit. This is at its most basic and minimum. Transaction occurs. So, for example, when a stockholder invests $2,000 in the business on June 30th, the date's recorded in the date column. The description column describes the accounts affected by the transaction. So you will use actual account names. Cash and paid-in capital are the accounts that were affected by this transaction. Additionally, below that will be a reason for recording this economic event or action. This is a small actual description of the transaction itself and why it was entered. In a general journal entry, the first account listed, or the first accounts listed in the entry, will be those accounts through which you are debiting. Then following that, you will indent. As you can see here, there's a little indent, and those will be the accounts that you are crediting. The amount that you are debiting will be listed in line with the appropriate account in the debit column. The amount that you are crediting will be listed in line with that account in the credit column. So the rules for journal entries are You have to have a reference date for every transaction. The general journal is a chronological recording of all the economic events that impacted an organization. Debits are recorded first, and credits are indented and recorded after debits. Keep in mind, because of the rules of double entry accounting, all debits must equal credits. So total debits in an entry will equal total credits. And you should always have a brief description of the actual transaction itself to explain why you are creating this entry. One of the things that I cannot stress enough is that with all transactions, there should be a source document. The bookkeeping process involves taking those source documents and recording the transactions that occur. They record them first in the Book of Original Entry, also called the General Journal, and then posting or taking those and transferring those transactions from the journal, where all they are is a chronological recording, and placing them in the ledgers of the accounts in which they belong. The ledger account balances are updated after every entry. Here we're showing you the visual representation of an account as a T account. We're going to look at some entries here and prepare the journal entries and post them to the ledger. These are the same A through F that we previously recorded in the horizontal model. We will post journal entries to the ledger accounts, as well as creating the general journal entry. Starting with A, transaction A was that on January 1st, the stockholders invested $2,000. This transaction is a basic transaction. We look at it and analyze it to see if there was an economic event on either assets, liabilities, or stockholders' equity. We know that cash increased. The reason to record this transaction is to record an investment by the stockholders. We start with our date, January 1st. We then recognize that there was an increase or a debit to cash. And remember, debit entries and debit accounts are listed first. So we debit cash the $2,000. And then we credit paid in capital, $2,000. The debit and credit amounts are posted then to the corresponding accounts in the ledger. The ledger account balances are updated after every entry. You'll see as we continue to move forward and we utilize these same accounts, how that will look utilizing a T account representation. To do that, let's look at transaction B. On January 15th, the company borrowed $6,000 from a bank. For the journal entries, the dates recorded in the date column of January 15th. The description column describes the accounts affected by the transaction, cash and notes payable. In addition, a reason for recording the economic event that occurred is also included in the description column. We just can't see it here. For this transaction, the bank was to record a loan from the bank. The reason was to record a loan from the bank. The amount of the debit to the cash account, $6,000, is recorded in the debit column. The amount of the credit to the notes payable account, $6,000, is recorded in the credit column. These debit and credit amounts are then posted to the corresponding accounts in the ledger, cash and notes payable. The ledger account balances are then updated after each entry. So as you see here, we have an $8,000 debit balance to cash and a $6,000 credit balance to notes payable. These are only two of the accounts that represent the entire accounting information system. Moving forward to transaction C, on February 1st, equipment costing $10,000 was purchased for $2,000 cash and signing a note payable for $8,000. This is a little bit more of a complex transaction because we're not just dealing with two accounts. We purchased equipment increased. We paid partially cash, and then we also signed a notes payable. So there are three different accounts at play. For the journal entries, the date's recorded in the date column. The description column then is going to talk about the accounts that are affected by this transaction: equipment, cash, and notes payable. You'll have your reason for recording the economic event or transaction, which, as I said, we cannot see that on these slides. The amount of debit to the equipment account, $10,000, is recorded in the debit column. We increased our equipment by a piece of equipment worth $10,000. The amount of the credit to the cash account, or how much we paid or decreased our cash by, is posted at $2,000. And then we recognize that the other $8,000 utilized to purchase this piece of equipment is in the form of a notes payable. We increase our notes payable by $10,000. The debit and credit amounts are posted to the corresponding accounts in the ledger, and we're going to look at that in the next slide. So just as a refresher, we purchased equipment for $10,000 by paying $2,000 cash and signing a notes payable for $8,000. We have taken the entry that we completed on the previous slide. We've now posted to each of the individual accounts. The ledger balances are updated after each entry. So we have here $8,000 of debit and $2,000 of credit. The difference in those means that we would have $6,000 debit balance. Let's look at the next transaction, transaction D. Equipment that cost $3,000 was sold for $3,000. The $3,000 will be received within 30 days. When you hear will be received, will be paid, on account, terms like this, you know that either an accounts receivable or an accounts payable is at play. We start the general journal entry with the date recorded in the date column. Then in the account title and explanation, or the description column, we recognize the accounts that are going to be impacted. Debits first, followed by credits. We then post the corresponding amounts in the correct columns, increasing an accounts receivable because it will be received in 30 days by $3,000 in a debit. And then we decrease our equipment because we sold a piece of equipment. We no longer have access to that asset through a credit of $3,000. After completing the journal entry, We then post the effects of that to the individual ledger accounts. Continuing forward, we are now to transaction E, where the company provided services to somebody and was received $8,000 cash for those services. We start with the date and the date column. We then analyze to determine $8,000 in cash is an economic event, cash or an asset increased. An increase to an asset is done via a debit. We will enter cash with an $8,000 in the debit column. Revenue also increased, but revenue increases with a credit. So we indent, we enter revenue, and we increase it through the credit column by $8,000. We take this summary of the transaction that occurred, and we transfer that general journal entry to the ledger accounts. Notice how cash, which was before $6,000 debit, now has a $14,000 debit balance. As those accounts are posted to and their balance is updated, you're going to have a running representation of the transactions that occurred, as you can see here, and then what the current status or balance of the account is. Now, finally, we're going to look at transaction F. Wages of $2,000 were paid in cash. Dates recorded in the date column. Accounts affected are here in the description column. And then their impact is tied here in the debit and or credit columns. After completing the general journal entry, we then post to the ledger accounts. Now think back to periods and periodicity, those artificial time frames. With those artificial time frames, what we do is at the end of a period, so at the end of a month or an end of the quarter or potentially the end of the year, we need to make some adjustments to bring accounts up to date for the financial statements. We record two types of adjusting entries: accruals and reclassifications. Accruals are transactions for which cash has not been received or paid, but the effect of which must be recorded in the accounts in order to accomplish a correct matching of revenues and expenses. Reclassifications are necessary because the initial recording of the transaction does not result in assigning revenues to the period in which they were earned or expenses to the period in which they were incurred. Adjusting entries, also known as either as accruals and reclassification entries, occur at the end of the accounting period. They're truing everything up so that we can present fair and accurate financial statements. Adjusting entries are needed whenever revenues or expenses affect more than one accounting period. Things don't nicely line up perfectly so that at the end of every month, everything has been paid and has been recorded. All economic events have completed and are fulfilled. Every adjusting entry involves a change in either a revenue or expense account and an asset or a liability account. Some examples of expenses to be accrued at the end of an accounting period are Those like wages and salaries, interest payable, property taxes, these are areas where we may have incurred an expense, but it has yet to have been posted or paid. So let's take a look at wages and how and why we accrue those. So on May 31st, Web Company owes wages of $3,000. Their employees have earned through May 31st $3,000 worth of wages. Payday is Friday, June 2nd. The rule of accrual accounting states that expenses are matched to the period when the revenue is earned. Considering that 3 days of wages were earned by employees during the month of May, but will not be paid out in cash until June, the wage expense for the last 3 days of May must be reflected in that month's financial statements. Please note that it is not necessary for cash to change hands in order to recognize revenues or expenses. A liability is recorded because on May 31st, the organization owes these wages to employees, regardless of when they will be paid in cash. Wage expense is debited for $3,000 to reflect an increase in the wage expense account. Wages payable is credited for $3,000 to reflect that liability, that obligation, the owing of that amount to the employees. The $3,000 increase in wages payable account records an increase to the liabilities that must be paid at some time in the future. These T accounts show the $3,000 increase in wages payable that is reported on the balance sheet and the $3,000 increase of wages expense that is reported on the income statement as of 5/31. Now, what happens after that? On June 2nd, employees will be paid for the entire week's wages of $5,000. It's important to understand how an entry for the actual fulfillment will occur as well. On June 2nd, with the payment of the 5 days worth of work of $5,000, wages expense is entered for only the 2 remaining days that were worked in June. You then reduce the wage payable that were accrued from May to represent the full $5,000 for the payroll. The liability for May wages will be reduced when the debt is paid. So when it is fulfilled or satisfied, in this case, paid out on a payroll in the form of cash. So accruing revenues. There are some times when a revenue hasn't been recorded yet. Interest earned and work completed, but not yet billed to customers are examples of accrued revenue. One industry where you can find work completed but not yet billed to the customer might be something in the construction industry, where they have reached a certain point of completion but haven't yet to reach a point where they can bill. So let's look at an example of that. On January 31st, the bank owes Web Company interest of $170. Interest is paid by the bank on the 15th day of each month. The January portion of interest owed to Web by the bank needs to be recognized as revenue in the month of January. They won't receive this until the middle of February. So initially, we recognize the revenue and we create a receivable. A receivable tells us that somebody owes us something. Web Company will debit $170 to the interest receivable and credit $170 to the interest revenue to recognize the revenue in the correct period, although the company has yet to receive that interest payment. These T accounts show the increase in the interest receivable asset account reported on the balance sheet and the increase in the interest revenue account that is reported on the income statement for the accrual of interest revenue on January 31st. Next, we'll take a look at what happens on February 15th. On February 15th, when the company receives an interest payment from the bank of $320. This is for the interest that accrued in January and the interest due for the portion of February to date. The receivable is to be collected in a future period in the original entry. Remember, $170 was accrued through January 31st. When we receive the actual cash, our cash increases. So it's debited by $320. That's the interest payment actually received. Interest revenue will be credited for the $150 earned in February. And the interest receivable will then be satisfied. We will have received it. So we will credit it and take it back to zero by $170. End of the month adjusting entries are also used to reclassify assets, as the assets are used, consumed, and therefore expensed. Some examples of these are prepaid insurance, which are insurance premiums paid in advance for more than one accounting period, and supplies, which are an example of assets that are consumed in the course of doing business and need to be reclassified as an expense. On January 1st, Web Company paid $2,400 for an insurance policy with coverage for 12 months. This is actually a typical normal thing that occurs. The insurance premium, because it covers 12 months, will be recognized as a $200 expense each month for the 12-month period. The initial cost of the insurance premium is recorded as an asset to the prepaid expense, prepaid insurance account. Prepaid insurance is debited and cash is credited for $2,400. Costs are expense as they're used to actually generate revenue. As time passes, the insurance premium is expensed. Each month, the insurance expense account is debited and the prepaid insurance account is credited for the $200 respectively. This is the amount of insurance that has expired, been used, been consumed. The $200 entry reflects that 1 month's use of prepaid insurance. The balance sheet account prepaid insurance is credited, and the income statement account insurance expense is debited for that $200 in every month for the 12 months. Some regular end-of-month adjusting entries. Unearned rental revenue and airline ticket advance sales are examples of liabilities that are reclassified to revenue at the end of an accounting period. Initially, a liability is recorded when a customer pays for a service or for a product in advance. So before they have received said services or products, they remit their cash. Revenue is recognized at the time that the product or the service is provided to the customer. This results in an increase in revenue and a corresponding decrease in liabilities. So let's look at an example of this. On January 1st, Webco received $6,000 in advance for a 1-year rental contract. You hear the word in advance. They received cash for something in advance. Therefore, we know that we owe service, product, or something. We owe something, that's a liability. Cash received in advance for goods or services that have not been provided to the customer are initially classified as a liability. The definition of a liability is an amount that is owed to some other entity in the future. This example meets the classic definition of a liability because the organization is responsible for providing the goods or services that are paid for in advance. If it does not provide what was paid for in advance, then the organization owes the customer a refund of the advance payment. Initially, revenues that benefit more than one accounting period are recorded as a liability. The receipt of the initial payment that benefited more than one accounting period was recorded as a liability. Cash was debited for the $6,000, and unearned rental revenue is credited for the $6,000. Over time, the revenue is recognized as it is earned. The 1-year advance payment of rent for $6,000 is divided by 12. This gives us $500 per month. Each month, a reclassifying entry will need to be recorded. The monthly entry will decrease liabilities by $500 and increase revenues by $500. Revenue is recognized once the organization provides the goods or the services that were paid for in advance. This process may take more than one accounting period to complete. Therefore, only a portion of the revenue is recognized that pertains to the goods or the services that are provided for that specific period. The remaining amount, in this case $5,500, will continue to be shown on the balance sheet as a liability. The balance sheet account and the unearned revenue account are represented here. Unearned revenue decreased with a debit, and the income statement account, rental revenue, increased with a credit after the journal entry was posted to the accounts. This shows that the organization has earned $500 worth of rental revenue that was paid for in advance. So last but not least, we're going to look at the 5 questions of transaction analysis. When analyzing a transaction, we seek the answer to these 5 questions. What is going on? What accounts are affected? How are they affected? Does the balance sheet balance? After going through our transaction analysis, do our debits equal our credits? And then last but not least, what might almost seem like common sense, but it is something that we have to take one step away and look and say, does my analysis actually make sense? We engage in what's called the closing process. The closing process simply transfers the year-end or the period-end balances of all income statement accounts, so revenues, expenses, gains, and losses, to the retained earnings account. In addition, the dividends account is then closed to the retained earnings. This process creates zero balances in the revenue, expense, and dividend accounts. These are called temporary accounts. They are there only to record the operations for a given period of time. This makes them ready to collect the transactions for the next period. By closing them out to retained earnings, which is a permanent account, we have recognized that we are starting a new accounting period. The normal balances for expenses, losses, and dividends are debit balances. The closing entry for those accounts results in a credit to the respective account and a corresponding debit to the retained earnings. Expenses, losses, and dividends decrease retained earnings. The normal balance for revenues and gains accounts are credit balances. To close them out, the closing entry for these accounts is a debit to the respective revenue or gain and a corresponding credit to the retained earnings. Revenues and gains increase retained earnings. Now that we've done a kind of broad 5,000-foot review on transaction, bookkeeping process, jargon, how things occur, what accruals are, what reclassifications are, you should have now been refreshed on most of the things that are imperative related to the overall process, accounting in general, as well as the history and standard setting through Chapter 4.